In this video, I'll be going over a variety of investment methods, from stocks and bonds to cryptocurrency. Investing is when one allocates money with the expectation of growth and positive returns after a certain time frame. Let's begin with the most popular place to invest money, the stock market. A stock represents partial ownership of a company, so if one is to buy a share, then he or she has a claim to the company's future earnings, making this a very lucrative investment method. However, with the possibility of great return also comes the possibility of large losses, making stocks a risky investment. A safer alternative is investing in bonds. What is a bond? A bond is a loan that is given either to the government or a company. With a bond, the government or a company takes the money from an investor and pays interest to the investor until the maturity time, at which the company or government must pay the original money back to the investor. Here's an example. Let's say Company X wants more capital to manufacture products, so they begin to sell bonds. The face value of each bond is $200. The maturity is 5 years, and the annual interest rate is 10%. An investor buys a bond for $200. Every year, Company X pays the investor $20, the 10% interest rate. Finally, in the 10th year, the investor redeems his bond and is given the original $200 that he or she bought the bond for. Bonds are typically a great source of passive income and are considered low-risk investments. However, bonds do vary in risk. For example, government bonds typically have a lower interest rate than companies because the government is more financially stable than a company, therefore able to pay the full price back. Next, let's discuss mutual funds. A mutual fund is an open-ended investment fund that is a pool of money from multiple investors to purchase a variety of investments, such as stocks and bonds. When one purchases a mutual fund share, they get a tiny stake in all investments in the fund. In this fund, there is typically a plethora of diversified stocks and bonds. This lowers the risk, as if one company or industry is doing poorly, the fund has a multitude of other securities that can make up for the losses. Another benefit of mutual fund investing is professionals managing the securities within the fund, making an investor's excessive market research unnecessary. Some downsides, however, are high sales charges and a chance of being manipulated or exploited by fund managers. Fourth is exchange-traded funds, or ETFs. An ETF is simply a fund like a mutual fund, except its shares are traded on the stock exchange. Pros include diversified stocks, like any fund, discounted share prices, and trading simplicity. Despite that, a major drawback of ETFs is that they come with high fees and expensive intraday pricing. Our fifth investment method is annuities. An annuity is simply a series of payments at equal intervals in exchange for a lump sum or stream of income in the future. Annuities are very beneficial for retirement because whatever contract is agreed upon between an insurance company and an investor stands no matter how long the investor survives. Some pros include more cash saved for retirement, and because there's no annual contribution limit, one can invest with either a lump sum or periodically. Lastly, we have cryptocurrency. Cryptocurrency is one of the most volatile, high-risk, high-reward investments available. It's basically a digital currency that has its production and trading determined by encryption techniques outside of an independent bank. Like stated earlier, the risk in investing in cryptocurrency is gargantuan, but the potential profits are as well. Advantages of crypto investing range from massive potential of returns and a shorter time horizon to cash out to increase liquidity. But some serious drawbacks are there is very high volatility and possible mismanagement of money.